Welcome back to the Japan Stock Podcast for today's deep dive into the source material. If you're joining us today, you are likely looking to uncover the hidden business logic behind one of the major players in the Japanese tech landscape.
Yeah, and we have a pretty complex mission for you today.
Exactly.
Right.
We are exploring the really dramatic turnaround strategy of ROHM Co. Ltd. We've been working through a stack of their recent financial results, their detailed fact books, and that newly released 2025 integrated report.
Trying to separate the actual structural shifts from just, regular market noise.
Right.
Because we are looking at a legacy company here. They're attempting to navigate a notoriously volatile global semiconductor market, and to do it, they're undergoing some rather ruthless self-reflection.
Unprecedented for them, really.
Completely.
That's okay.
The materials outline an organization fundamentally reevaluating its operational DNA just to survive the current cyclical downturn.
Okay, let's unpack this. We're looking at a company that started out in 1958 manufacturing, tiny resistors.
Right.
They've weathered decades of market crashes, physical disasters, and now they are willingly deciding to restructure their entire identity. But to understand where they're going, we really need to establish where they came from.
Yeah, the origins are fascinating. It traces back to Kenichiro Sato, founded the company in '58. And the corporate name itself is actually a literal reflection of their industrial mandate.
Well, the trivia on this is great.
It is. The R stands for their original product resistors, while also doubling as a commitment to reliability. And then they combine that with ohm, the standard unit of electrical resistance.
It's a very pragmatic foundation.
Very.
Today, they operate as a massive electronics and semiconductor manufacturer, deeply embedded in consumer electronics, automotive systems, primarily supplying LSI chips and discrete semiconductor devices.
With a heavy, heavy emphasis on power devices.
Right. And beyond the hardware, their historical reputation in the market is really anchored by their disaster recovery capabilities. The supply chain resilience is legendary. The reports highlight this ingrained corporate culture of just fulfilling customer orders regardless of external shocks.
The operational case studies in the materials are wild.
They really are.
Following the 2011 Tohoku earthquake, which severely damaged their Miyagi plant, they managed a complete restart in just 3 months.
Which is incredibly fast. But the Thailand flood disaster is an even more extreme example.
Oh, absolutely.
Their manufacturing facility there was submerged in 1.8 meters of floodwater. Most companies would just write off the quarter or relocate entirely, not ROHM. They ran high-voltage power lines up to the dry second floor and resumed production in exactly 1 month.
Which is just operational grit at its finest, and that built incredible loyalty with their clients. But, and here's the pivot, that same old-school dedication to doing things the hard way eventually contributed to an internal bottleneck. The current CEO, Katsumi Azuma, he identified that the company had basically lost its operational agility.
He recognized they were bogged down by their own legacy processes, excessive internal checks, a bureaucratic development cycle that was artificially extending their time to market.
So to correct this, Azuma is pushing a massive cultural reset. He calls it Gensen Kaiki, which translates to back to basics. He formally introduced the 3S culture into the corporate governance structure.
Speed, speciality, and severity.
Right. And in the context of traditional Japanese corporate culture, which has historically leaned heavily on lifetime employment, consensus-based advancement introducing severity is a shock to the system.
It's a strict meritocracy, evaluating personnel purely on results. That is a massive structural departure from the seniority system.
It's a necessary departure when you look at their chronological growth story. I mean, ROHM experienced massive expansion throughout the 80s and 90s. They aggressively captured market share with custom ICs, highly profitable during the consumer electronics boom.
But the bursting of the IT bubble in 2000 fundamentally shifted the Japanese electronics landscape.
And they struggled to adapt to that shift initially. By 2012, their sales had contracted below 300 billion yen, resulting in an operating loss.
Which forced a pivot. And over the past few years, management made a highly concentrated, massive capital bet on the electric vehicle boom. They aggressively expanded their production capacity for silicon carbide, or SiC-powered devices.
Which, from a pure physics standpoint, was the exact right technological bet.
Absolutely.
Silicon carbide handles vastly higher voltages and thermal loads than standard silicon. That translates directly into better battery efficiency and faster charging times for EVs. The issue wasn't the technology.
No, it was the macroeconomic timing.
Exactly. The broader EV market experienced a harsh reality check over the past 18 months.
We saw government subsidies dry up across major markets, consumer demand plateaued because of charging infrastructure bottlenecks, and traditional automakers started scaling back their EV production targets. It created a massive bullwhip effect in the supply chain.
And ROHM was left totally exposed.
Yeah.
EV manufacturers had aggressively stockpiled components during the post-pandemic chip shortage. When demand cooled, those manufacturers simply stopped ordering so they could burn through their existing inventory.
So ROHM ends up holding the bag. Bloated inventory levels, heavy capital expenditures deployed for factories that were suddenly operating way below capacity.
Which brings us to the financial fallout. For the fiscal year ending March 2025, ROHM recorded a 40 billion yen operating loss.
40 billion.
That is their first net loss in 12 years. You don't just post a 40 billion yen loss as a legacy manufacturer without institutional investors demanding immediate accountability.
Right. How does management justify that kind of bleed to the market?
By taking their medicine publicly, CEO Azuma declared the period from 2025 to 2027 a formal structural reform period. They are not attempting to frame this as just a minor cyclical dip.
No, they are actively shrinking their footprint to stabilize their margins.
Yeah.
So what does this all mean? In the integrated report, they refer to this strategy as crouching down to jump.
It means aggressive capital discipline. They have slashed their ambitious 3-year capital expenditure plan nearly in half.
Cutting it from 280 billion yen down to 150 billion yen.
They are optimizing their headcount, too, which included securing 200 voluntary retirements at their headquarters.
And furthermore, they are completely exiting the legacy silicon wafer business by March 2025.
That specific exit is calculated to directly improve operating profits by approximately 1 billion yen annually.
They're cutting the dead weight, and this restructuring requires a hard look at their geographic revenue distribution. Management is aggressively targeting an overseas sales ratio of over 50%. Relying predominantly on the domestic Japanese industrial base is just no longer a viable growth strategy for a semiconductor major.
It isn't, and the regional analysis in the fact books reveals a really complex dynamic, particularly in China.
Oh, the China anomaly from the report is fascinating.
It really is. China remains a critical market for their components, but the supply chain variables are highly unpredictable. Interestingly, the sources highlight a recent situation where a temporary halt in shipments by domestic Chinese capital semiconductor makers actually served to stabilize global auto production schedules.
Right, because the market became slightly more predictable without that constant flood of cheap domestic chips. And that surprisingly benefited ROHM's high-end component sales in the region.
It perfectly illustrates how intertwined and hypersensitive semiconductor supply chains are to local disruptions. Beyond China, they have aggressive growth targets for the US and Europe, heavily focused on capturing market share in automotive and industrial automation.
But evaluating the overseas revenue of any Japanese exporter right now requires factoring in the massive currency fluctuations we've seen.
Oh, currency volatility has been a major distortion in corporate earnings across the Nikkei all year.
Exactly. If we look at their FY 2263 revised forecast, the yen's depreciation was a significant variable. The yen was averaging between 146 and 152 to the dollar, and they are projecting 153 for the fourth quarter.
Which is incredibly weak.
Right, and when they repatriate those overseas earnings, that weak yen artificially inflates their top-line revenue. It provided enough of a paper buffer for them to revise their overall sales forecast upward by 20 billion yen, targeting 480 billion yen total.
That foreign exchange windfall provides temporary relief to the income statement, sure, but management is fully aware that you cannot model a 10-year business plan on favorable macroeconomic currency trends.
You have to fix the underlying unit economics.
Exactly, and what's fascinating here is the core business logic they are deploying to achieve that. Let's examine those core business drivers.
The first major variable outlined in their strategy is what they term a partial breakaway from IDM.
The integrated device manufacturer model. That has been the gold standard for Japanese semiconductor companies for decades. Historically, ROHM's competitive moat was rooted in total vertical integration. They designed the chip, fabricated the wafer, assembled the package, and conducted all the testing strictly in-house.
Maintaining that level of vertical integration gives you absolute oversight on quality control, which automotive clients demand, but it requires astronomical capital expenditure to maintain the fabrication plants.
Fabs are massive fixed-cost black holes.
They are. If global chip demand drops by 20%, you still have to pay the enormous costs of keeping the clean rooms running and the equipment calibrated.
Which is why this strategic shift is so profound. To survive the extreme demand fluctuations we are seeing today, ROHM is abandoning pure isolationism. They are actively outsourcing the manufacturing of their generic, lower-margin products to external foundries and OSATs.
Outsource semiconductor assembly and test. Handing that over to third parties is a major concession for a company that historically prided itself on doing everything.
But mathematically, it is the only way to build financial resilience. They're systematically converting rigid fixed costs into flexible variable costs.
Right, when the next cyclical downturn hits, they simply reduce their orders to the foundries rather than bleeding cash to keep their own factories open.
Crucially, though, they are not outsourcing everything. They are fiercely protecting their intellectual property and margins by keeping the fabrication of their cutting-edge, high-value tech, specifically the silicon carbide power devices, strictly in-house.
It's a hybrid manufacturing model that balances margin protection with capital efficiency. Now, the second major driver dictating their future is their strategic pivot toward data centers and AI infrastructure.
They have historically over-indexed on the automotive sector, while their industrial and consumer tech segments lacked a strong growth catalyst.
But the generative AI boom is completely altering that landscape.
Training and running large language models requires colossal compute density. It's triggering a massive wave of capital investment into hyperscale data centers globally. The thermal and power requirements for these server racks are just unprecedented.
Memory supply is tightening across the board, and the demand for specialized server infrastructure is accelerating. Now, ROHM isn't competing with NVIDIA or AMD to design the core AI logic processors.
No.
Instead, they are positioning themselves in the critical surrounding infrastructure. They are accelerating the development and commercialization of optical modules specifically engineered for AI servers.
Because as data transfer speeds increase inside the server racks, traditional copper wiring generates way too much heat and latency.
Exactly. Moving to optical data transmission is mandatory, and ROHM is trying to capture that specialized component market.
It is a classic secondary derivative play on a megatrend. They are supplying the critical picks and shovels for the AI data center build-out.
Let's move to the third major driver, which involves their capital structure and some pretty aggressive financial engineering. Here's where it gets really interesting. The integrated report details massive strategic alliances that mark a clear departure from their historical independence.
ROHM has deployed a 300 billion yen strategic investment into Toshiba. That is an enormous allocation of capital aimed at securing a structural partnership.
When you look at what Toshiba holds, particularly their legacy strength in power devices and industrial infrastructure, you see why ROHM wanted a seat at that table.
And we also have to analyze the news regarding Denso's strategic moves, specifically the TOB developments involving ROHM to solidify their ecosystem.
Right. Denso is one of the world's largest automotive component suppliers, tightly integrated with Toyota. By partnering through these equity and TOD mechanisms, they're effectively locking in a long-term, stable demand pipeline for ROHM's mobility and decarbonization components.
These alliances indicate management's realization that the scale of capital and R&D required to compete with global semiconductor giants in the 2020s is simply too vast for any single Japanese manufacturer to shoulder alone.
Consolidation and strategic equity tie-ups are becoming a baseline requirement for survival.
They really are. And alongside those operational alliances, we need to analyze their accounting methodology. Because starting in the fiscal year ending March 2026, ROHM is officially changing its depreciation accounting from the declining balance method to the straight-line method.
Okay, the declining balance method aggressively front-loads depreciation expenses, meaning you take a massive hit to your operating profit in the immediate years following a major capital investment like building a new fab.
Right. And the straight-line method smooths that exact same expense evenly across the entire useful life of the asset.
So, by simply shifting the mathematical formula on paper, ROHM instantly reduces their projected depreciation expenses for the coming year by over 14.2 billion yen.
That is 14.2 billion yen that bypasses the expense column and immediately bolsters their operating profit line.
It's a completely legal, standard accounting maneuver, but you have to view it critically. Isn't this just financial window dressing to pacify angry shareholders while the actual physical restructuring takes time to execute?
I mean, it certainly softens the optical blow of their recent CapEx binge. It buys the executive team time. By reducing the immediate depreciation drag on their earnings, They can present a faster path back to profitability to the institutional investors.
And the relationship with those investors is undergoing a radical shift, largely driven by their newly appointed CFO.
Peter Knevin, elevating a foreigner and a former external director to the CFO position of a legacy Kyoto-based hardware manufacturer is a glaring signal to the market.
He brings a detached global investor perspective to a balance sheet that was burdened by decades of institutional inertia and bloated asset accumulation.
Knevin is unburdened by the emotional attachments or the sunk cost fallacies that typically plague executives who have spent 40 years climbing the internal corporate ladder.
Right.
His mandate, fully supported by CEO Azuma, is heavily weighted towards shareholder returns, even in the face of their recent operational losses.
Their dividend policy absolutely proves that point. They posted a 40 billion yen operating loss. The standard, conservative corporate playbook in Japan dictates that you immediately slash the dividend to preserve cash during a restructuring.
But ROHM refused to do that. They stubbornly maintain their dividend at 50 yen per share.
Retaining the dividend serves two purposes. It projects operational confidence to the market, signaling that they view the loss as a temporary cyclical bottom rather than a permanent structural decline.
And secondly, it honors a commitment not to penalize the shareholders for management's miscalculations regarding the timing of the EV market slowdown.
Their stated capital allocation framework now targets a 30% consolidated dividend payout ratio. But CFO Knevin's looking deeper than just the dividend yield. His primary objective is aggressive balance sheet compression.
Like a lot of mature Japanese tech firms, ROHM has historically hoarded cash and maintained significant cross-shareholdings or underutilized assets. Knevin is systematically compressing those net assets to force their return on equity, their ROE, back above the 9% threshold.
It requires a ruthless focus on capital efficiency. By optimizing their asset base and strictly controlling CapEx, he aims to transform ROHM into a leaner entity that prioritizes the generation of free cash flow.
Because reliable free cash flow enables them to organically fund their transition into AI optical modules while consistently returning value to shareholders through dividends and flexible share buybacks.
It is a highly westernized approach to corporate finance being overlaid onto a traditional manufacturing core.
Which brings us to a synthesis of their immediate future. The next 1 to 3 years for ROHM are entirely dependent on the flawless execution of this structural reform.
They have to manage the friction of transitioning to a hybrid IDM model without compromising the quality of their high-end SiC products.
They must maintain strict capital discipline while waiting for the EV supply chain inventory to normalize.
And they must successfully commercialize their AI data center components to offset the sluggishness in automotive. They are completely dismantling the old rules of Japanese semiconductor manufacturing to survive a hostile global market.
If we connect this to the bigger picture, though, the shift away from total in-house manufacturing introduces a really profound secondary variable.
What do you mean?
By outsourcing their lower-tech generic product lines to external foundries and OSATs, many of which are geographically concentrated in Taiwan and mainland China, ROHM is effectively trading internal financial risk for external geopolitical risk.
Wow, that is a critical trade-off. They are solving their fixed-cost CapEx burden. But if geopolitical tensions escalate in the Taiwan Strait, or if new trade embargoes disrupt cross-border semiconductor logistics, ROHM no longer controls its own end-to-end production.
Exactly. They might achieve a 9% ROE on paper today, but they are increasingly vulnerable to catastrophic supply chain blockades tomorrow.
It forces you to question whether the pursuit of capital efficiency in the semiconductor space inherently requires accepting an unacceptable level of geopolitical exposure.
It's a macro risk that every global tech investor needs to continuously monitor.
A fascinating dilemma to leave you with, balancing the balance sheet today versus securing the supply chain tomorrow. Thank you for joining us on this deep dive into the source material. We encourage you to keep dissecting the financial footnotes, watch how those external OSAT partnerships develop, and track whether this hybrid manufacturing gamble actually pays off. Until next time, keep digging into the data.